Warren Buffett just made a big bet on real estate. We're going to dig into that in more reports today on the Gray Report. If you're a multifamily investor, you're active, passive, you're in the industry, you're in the right spots. Every single week on the Gray Report, we're breaking down all the latest research reports, news, data, anything that's going on related to multifamily, housing, commercial real estate, and the economy. And great reports this week. Again, from the Wall Street Journal, Berkshire Hathaway's latest bet is on home builder stocks. We're going to get into what that means for the real estate industry and just what that could signal for future positive momentum. We're also going to be talking about a piece from John Burns Real Estate Consulting. How long will the home builder euphoria last? Very much related to the Berkshire Hathaway piece. And then a report from RealPage. How far is each market past peak apartment construction, or are we even past peak construction? Really important to understand where the supply dynamics are headed. And then finishing things out, a piece from the New York Times, why this company's financial crisis threatens China's economy, talking about some of the problems over in China in their housing market. Does it even matter to the U.S. housing market? Well, everything's connected to some degree, so we'll see how much. Also talking about my conversation with Grant Cardone, an example of a recent refinance here at Gray Capital. You're going to want to stick around, subscribe, leave a comment. Let's get into it. Welcome back to The Report. Dr. Matt Bosnagel, Director of Communications and Marketing here at Gray Capital.
Good to be back.
Pleasure to have you back, man.
Yeah.
It's an exciting week. We had a big week last week. You were out for a little bit.
Yeah.
You're missing.
Had the Eris strain of COVID.
What is it? What's the new strain?
ERI5. It's Eris or
Eris.
It's got a name though.
Yeah.
That's all you need.
Interesting. Well, I thought COVID didn't exist, Matt. But according to you, apparently it does. It's still around.
Got it. I'm sure the fish in my fish tank have it. My whole house was just no-go zone.
Well, I'm glad you guys are doing better back in the seat. I mean, obviously, just from last week to now, a couple days down. Was it as bad as previous times, or was it?
It's about the same. It seems like it was more effective. It was like, I already infected my brother and his.
Not good.
Horrible.
But good.
Yeah.
Good.
Yeah. I know. Let's get
report.
them on. All right. Yeah. Hey, I'm curious about what's happening and what happened at Gray Capital while I was gone, because there was a couple of big things, and I'm a little sad that I missed them.
Yeah, you missed out.
Yeah.
That's what happens when you test yourself for COVID. That was the problem.
Yeah. Okay.
I was like, why'd you test? But your wife works in healthcare. Probably has a couple tests.
Yeah. We couldn't help ourselves.
Yeah. Well, they were giving those tests out, but. Anyway, exciting week last week. Wednesday, did an interview with Grant Cardone, which is pretty cool and exciting. Really interesting conversation. He reached out to us after, we put out the loan maturities, potential distress and multifamily market report. You can find that on the Gray Capital website. He was really interested in the report, and he started listening to the podcast, and thought it was a lot of useful information. Got in touch with me, and we talked about the real estate market, multifamily, where we think things are going, what's going on at Gray Capital, and generally kind of my outlook on the market. Obviously, Grant it buys a lot of real estate, a lot of multifamily. It's been investing in real estate for quite some time. We're in different markets, although we're looking at some of the same markets. He definitely has a different approach than we do, but definitely have some similar thoughts on kind of real estate in general from a long-term hold mindset, buying at, strong basis, focus on cash flow. And then he also, really wasn't prepared. I mean, when I went on, first off, he's a great interviewer. Probably one of the best interviews that I participated in. There's no intro. It's like you go into the meeting, Grant's there and it started. It's not, we're going to talk about a couple things. He doesn't do a ton of research on the guests, so it's all kind of fresh.
Yeah.
There was a rapid fire of just kind of a yes or no on different markets and some ideas and kind of concepts. And which, we talk about markets all the time. So I had a pretty decent opinion. Now the challenging thing is what I had to, qualify is, sometimes there can be a good market for maybe just the general multifamily investor, good or bad, but then relative to, for me and Gray Capital, and our ability to execute. There's a difference. For example, he asked about Houston, where he's investing. He's like, yes or no, Houston? And I said no. And he's like, why not Houston? And I'm like, well, one, you're there, Grant. There's a ton of buyers in Houston. I go to Houston, who's Gray Capital, who's Spencer Gray, take a number. It's going to be hard to break in. And by the time I learn, all the players and everything about that market, I know confident I can do it. But there are more opportunities, better opportunities that I can execute on much more efficiently and effectively in the markets that we're already in.
I wonder, and this is a little bit outside of your discussion with Grant, but I wonder, what is the dollar value or the percentage value of trying to get an apartment deal, trying to buy an apartment at a market where you have a good relationship with the brokers, where you've bought and sold, versus one where you just don't know the brokers. You've not done any business.
No, it's a really good point. And because there often is a premium that you may have to be prepared to pay to get into a market. You really shouldn't, ideally. You never want to pay a premium, and it still has to work. But I mean, if I take Indianapolis as an example, our home market, if it's us if the deal's with a broker that we know, that we have a relationship, we talk to every single week, we see each other in person all the time.
Yeah.
We've done hundreds of millions of dollars of business together.
And there's that incentive, exactly, to continue.
They want us to bring them their deals to sell. They want to sell us deals later on. We're going to be around. If it's us at the same price and the same terms versus someone that's flown in from wherever that no one's ever heard of, and they're helping the seller decide who to pick, I mean, which way are they going to kind of direct them to go? Hey, here's a group that we've done 6, 7, 8, 9 deals with, performed every single time, great, easy group to work with. This is I can tell you exactly what it's going to look like. Watch out for this because, they're good at negotiating or whatever. But versus, I don't know anything about these guys. Maybe they've got a website.
Yeah.
Who knows?
It is interesting how much, and again, if the price is right, these issues are easier to kind of smooth over, but the amount of these a soft trust and how quick can things happen?
Well, it's relationships. I saw a post on LinkedIn. I forget who posted it, but it was somebody who lost some business to a competitor. They were a broker and they were trying to sign up a deal to get the listing. And he's like, the seller, he asked, why didn't you go with this? He's like, well, I'm neighbors with the other broker.
Yeah, see, that's hard.
It's hard. It's hard, and sometimes you have to. It's important for relationships or everything. You never want to hold yourself back just because of a relationship. Of we've been working with this guy for a while, and we know him, or there's a connection there, or a family, or a friend, or something. That's great, but if you have to watch that. You don't want yourself to be taken advantage of at the same time. Yeah. So we're going to get on just a little off topic, but a really good conversation with Grant.
And that's what I was wondering too. He talked about Houston and if he's there and he knows the brokers, then that's an incredible advantage. I was interested.
Well, and he's got the notoriety too. Yeah, I mean, think about, him putting himself out there. Obviously he can raise money from investors pretty easily just because he's a known quantity. I mean, I've talked to a lot of investors who've gotten in touch with us who they're like, oh, I didn't know anyone else besides Grant Cardone was doing this. Because I've heard of multifamily investing and syndication through him, and he's just the name brand. I didn't do a bunch of research, and which is, you should do a lot. You should do your research. But
did he? I mean, is he have the same opinion of Midwestern markets? Is he interested still in the Sun Belt, or what's
Good question. I mean, he's still South Florida, which I told him. He's they're at Miami. I was like, yeah, no, Miami all day long. I mean, obviously it's expensive, but for good reason. Yeah. I was like, other parts of Florida, no. I was like, but Tampa, yes. I was like, Orlando, maybe not right now. And so I think he's still focused on the Sun Belt because for the long term, I still think that thesis makes sense once we get some more absorption. But he's looking at the Midwest more. He was asking me a lot of questions about the Midwest, which markets that we were in, which ones we liked. Because he was up in Chicago recently looking at deals, a big deal that I think he could get a good price on, and we share concern about some of the issues, some of the risks with investing in Illinois, but also the great little spots in Chicago that are growing quite a bit. So yeah, he's looking in the Midwest, like a lot of groups are starting to take a look at markets like Indy, Columbus, Cincinnati, Kansas City,
and
Lansing.
The supply dynamics, which we'll kind of get into, are more favorable than you'd think. Even in like even if you're comparing, now into then, it's like we may be cresting at the peak of supply for some of these Midwestern markets, and this is getting ahead of myself. But it's not a bit, it's not a big crest.
No, it's definitely something that's sessionable. It's like
stable.
But we're definitely seeing, and I know we'll get into it, but I mean, we're definitely seeing some of the supply pressures, and we've had vacancy, tick up a little bit. Rent growth is still growing, but definitely in some Midwestern markets, we've some negative absorption has translated to some increase in vacancy. Still overall positive rent growth with those deliveries being kind of higher end units with higher rents. But compared to the Sun Belt, it's just a fraction. Of the supply.
It is funny.
But we talked about some of the challenges on the upcoming loan maturities coming up, the different prices, where cap rates may go, what makes sense, and kind of where cap rates need to be to make sense of a deal. And it really kind of centered around again a lot of these purchases of assets back in 2021 at peak pricing, peak rent growth, low interest rates, bottom floor of interest rates, and buyers buying on these short-term, bridge loans, but then they didn't get any growth. They didn't get any rent growth. And now their loans are coming due, and they either can maybe get an extension, but you have to pay for that extension, have to pass certain cash flow thresholds with tests, which are not easier said than done. But in most markets, you've had, negative rent growth, higher expenses. So like NOI is flat at best, if not negative. And then your leverage is different.
That's a good point, because like if you think about now, and then I could be way off base here, but it is like a little bit of a perfect storm, and it didn't have to happen this way. But like rents are cooling right when we're in the midst of this like addressing inflation moment. And you'd think that rents would be high, and normally if it was like we're addressing inflation, rents are high and along with all these other expensive. But no. We're addressing inflation at the same time that rents are low.
Well, and rents were high. They'd already gotten very high. It's just everyone expected them to get so much higher. Which that's where the breaking point for a lot of people were, and there was a divergence of people were either modeling like 10% rent growth for the next like 5 years, maybe 20% year one, which 20% year one at a point in time in early 2021 could have made sense, or 20% over a couple of years maybe, if you had other expirations, or if you were doing a value add plan, if you were forcing it. But if you were just relying on organic growth, which a lot of people were because it was happening. It was just the recency bias. The rent just grows by 10, 20, 15%.
That's how the world works.
It's just how it always worked like that. It's totally sustainable. But just an example. And then this was celebration last week that you missed, man, on Friday. It's okay. But we in the Great Capital portfolio, we only had one property that was still on a bridge loan for this period. And it was before interest rates. We bought it before interest rates started moving up, before we closed in December Q4 of 2021. A lot of bulk of these acquisitions took place, and we took out a bridge loan because it was an appropriate use of a bridge loan. We were going in to execute a value add plan. We were going to move to a permanent loan as soon as possible. We went in, we renovated about 30% of the units at the property, because it was down in Bloomington, Indiana, and there was a major concentration of lease expirations in June and July, and like almost all were in June.
Students?
It was on the student. There were some students, but it was market rate. A lot of just regular folks, but it was on sometimes in student college towns, even the market rate housing. They have their leasing schedule like on the same calendar as the school calendar, which means like all of the leases expire in summer, and you do a big lease up at like one point in the year. And student properties will bring on like extra staff, and it's like everyone's coming to school at the same time. You want the leases to start, in August or whatever. So, but there was no reason for all these leases to be so concentrated. And there's a lot of risks, because if you don't do that lease up, it's like we're going to go from 100. Literally, it was like we're going to go from 100%. And this is what happened, and this was on purpose. Was we need to do this renovation. We went from 100% occupancy down to like 70%, maybe 69% occupancy at one point. So we needed the leases to turn over We went in, did a very quick renovation. We redid floors, appliances, light fixtures, hardware. We didn't like redo every single thing in the unit, but we made some really nice targeted, upgrades. Got nice premiums. I think we got about $250 to $300, per unit on the premium. Did the renovations, leased them all up, got the premium, went from 100 to 69, then all the way back to 100%.
And you were kind of racing against the clock, maybe because of those rules you just mentioned.
Yeah, exactly. Okay. So we had a 2-year term on this bridge loan, and at the end of that term, you have to refinance or sell. There's an extension option also, but in the extension is about $100,000 you have to pay. Okay. That you don't get that back. It's just a fee to extend, and you have to pass a debt service coverage test. There's a test like, hey, before we just give you this extension, how are you doing? And so along this time, we've renovated the units. We're fully leased back up. We get the rent premiums, just crushing the business plan is going exactly as intended.
Yeah.
Except for two things. One, interest rates are moving. We're on this bridge loan, so it's uncapped. We started paying at probably interest rate of call it 4%.
Yeah.
As of last month, we were paying almost 8%.
Yeah.
So we were doing really well from our revenue standpoint, and even NOI growth had been awesome. But we were paying so much more in debt service.
So the bridge loan was
it's floating. Most bridge loans are floating rate.
Okay.
And then the other piece is the bridge loan is floating rate, but we also had expense inflation. Yeah. Because all of our operating costs.
Oh yeah, we talked about this. Rising expenses, lower rents. Now the loans are coming due.
So the only difference between us and most of the other market, and there's some other people that are did really well in their business plans too. We're not the only ones.
Yeah.
And I'll just fast forward here. So we other than interest rates going up and expenses, we had to make some very quick decisions to control some of those expenses, realign our budgets to make it work, because we knew we had to land the ship land the plane within a tight window.
And this happens, I'm sure a lot of the solving of whatever problems could happen happens when you get it at moment one, rather than like, we'll figure it out as we go.
Yeah, well, you want to assume that you're going to stick to your budget, but then just certain vendors. Is the year started, this year, 2023, essentially, and basically all our contracts you're starting to reset, and all our vendors come back to us, and we just price increases across the board because everyone was still catching up to all their increases, and everyone had just asked for a raise. So everyone just had to increase their costs. But we managed on the expense side. So we still got some really good NOI growth. We had to have discussions with probably 5 different lenders, quotes, work through the process, working on terms to get to a point where we could refinance and even get close to a neutral cash refinance, which means typically when you refinance, the whole idea, it's a great thing, is you refinance, and usually it's not just to roll the debt and get a new loan and change your interest rate. Oftentimes the value is increased, and so there's actually a tax-free cash out that's then can be distributed to investors or used for additional repairs or to fill up reserves, whatever you want. That's what everyone's business plan was, to either sell or refinance in 2 years.
Yeah.
Pull all the money on a refinance or sell it and 2x your money in 2 years. We could barely get to the point of where it was a neutral closing.
Yeah.
It ended up we actually got some cash out, which was really exciting. And because we went from one point, we had lenders tell us we were going to have to bring anywhere from $200,000 to $700,000 to the closing table just to put on new debt in place.
Wow. And this was due to kind of in the negotiations with the different lenders, or was it an effect of the rate environment at the time?
A little bit of both.
Yeah.
A little bit of both. It was the rate environment was the chief culprit.
Yeah.
But different lenders can look at different opportunities differently, different assets, different executions. They have different relationships with, with Fannie and Freddie Mac, and some can be a little bit more, aggressive when you need them to be, and know when and where to push.
Okay.
And some are great in certain situations and others in others. We try to go to a lot of different lenders and have a lot of different relationships.
Yeah.
And keep doing business with the really good ones. And so it took a lot of digging to get the right financing. We ended up getting great financing terms. Fannie Mae loan, we got 35-year amortization, 10-year term, fixed interest rate. I mean, we locked interest rates just right before the last Fed meeting where they announced an additional rate. Rate bump, which the 10-year has already popped up. I mean, if we had tried to refinance this week, and again, this is how quickly things are moving.
Yeah.
I mean, if we not closed last week, we would have lost our rate lock, which means we would have a rate lock again, and we would have had to bring money to the table, which means we would have to go out to our investors and raise additional capital.
Okay.
Which means returns go down. No one wants to do that.
Yeah.
We had already secured kind of backup rescue capital, through our just internal investor base, so we knew exactly what we were going to do. And we had a unique way of structuring that would have been as accretive as possible. But no longer the case. We were able to lower, we were paying, almost 8%. Now we're paying low 5s.
Having that plan in place is crucial too, though. It's like you're operating within some a domain that and you have a plan for.
Yeah. Well, and we're also talking to we're always talking to our lenders, but we were talking to the lender on this property, throughout the whole period, and communicating with them and what the plan was. I mean, we were never in a position where it was troubled, because we were always cash flowing. And we had a lot of options, and it wasn't as though where, in some of our analysis on kind of the average deal, you might have to bring 50% of the equity to the table, very easily. We were never in that situation. It was just, we were gonna have to bring some more money to close. And we also had a bunch of reserves at the property as well, which we didn't want to go through, clearly. But we were able to navigate it. So, we don't have any other, we pretty much have, minimal interest. We have no interest rate risk on that deal. Very minimal interest rate risk across the portfolio. No more bridge loans. Everything's long-term, almost all fixed. We got a couple, long-term floating rate deals that are capped. Leaders out on those cap expirations. A lot of reserves in those deals. And so, but we feel really good. Yeah. Because that was the one deal that, again, was performing, or the fundamentals, which is the story of multifamily. The fundamentals are so strong, but we're just just the way that this is financed is troubling. We're able to get that figured out, get that closed. Really good footing for a long-term hold, which has always been the plan.
It's interesting. It's comforting to have that guarantee in this environment, but I am wondering, so we're locked in then to when you're talking about it's a long, you're rate locking, we can't refinance when interest, if interest rates go back down.
We could, but there'll be a prepayment penalty.
Okay.
Yeah. And so that's the risk and reward, where how much risk you are willing to take. I mean, there's a good argument hey, put in another floating rate loan on it, put another bridge loan on it, because rates are going to be low in 2 years.
That's exciting.
Flexibility. Yeah, it's exciting, but
roll the dice.
But here's what I do is, I think about from an LP's perspective, what was their perception of risk going into the deal? Not that it's always correct, but what did they think that they were investing in? Mm-hmm. And most LPs, when they were investing in this deal in particular, were not thinking we're going to roll the dice and just go from one floating loan to the next, and let's see where interest rates are going to be in 2 years, and I'm going to say I'm going to time the market with interest rates. Yeah, that's not what they signed up for. I'm certain that's not what they signed up for. Yeah. Even though if some may be do it, I'm okay with it. Mm-hmm. You have to be thinking about the whole group of LPs and what the business plan was, and just what the level of risk that we say that we're comfortable with. Yeah. And so, we're removing part of that risk entirely. It means that we're probably going to hold on to it for a longer period of time. We're probably going to hold on to, we always go into these deals we're going to hold on to them for a long period of time. It's only if, the price has increased so much that we can't not consider selling it. But even then, I'm going to consider refinancing it and pulling equity out, before we'd even sell it. Let's hold on to it and, build wealth and build a portfolio. So we're still in direct alignment with our business plan. Mm-hmm. It just, we have a little more certainty of what the next.
That's nice. We've been talking a few times, and I'm sure, our listeners are well aware of a lot of these firms that are caught on the wrong side of interest rates.
Yeah.
And
billions of dollars.
We were in the same time scale as some of these people that were caught flat-footed, but by approaching the deal the very outset and knowing like, all right, this is not going to be a dice roll deal, like you said, as much as maybe some investors might be interested in that.
Yeah.
That wasn't the plan. And it wasn't like,
well, we changed our strategy.
Yeah. Oh yeah.
And we changed our strategy after that. Once we knew interest rates were going to start move before they even had, we said, we're not going to do any bridge loans anymore in this time period because it's just not worth the risk.
Oh, the acquisition strategy, not for the property.
Mm-hmm. Okay. Yeah. Sorry. Yeah. Acquisition strategies, because we did 2 deals in 2022 that would have been completely appropriate to close on a bridge loan. Close on a bridge loan because they had a value add component. Then value add, refinance, to a permanent loan after we complete the business plan. Totally would have made sense. And the last decade, 12 years or so, when things were a little bit more just linear growth rates, like weren't moving around so much month after month. I mean, it was basically the similar rate environment for a couple of years. Similar cap rate environment, similar rent growth market.
Yeah.
You could use a bridge loan to truly bridge just over your permanent financing without taking on that much risk. But that completely changed.
Yeah.
Completely changed in early 2022. And we saw that, acknowledged it, and said, we are unwilling to take that kind of risk. Now, if we could have gone back to, we would have had to go back to, October of 2021 to say, okay, we're not going to do any more bridge. Even before that, really summer of 21.
Yeah.
To say that, we're not going to do any more bridge loans.
Yeah.
But there was really no evidence other than, there was certainly some inflation was picking up at that point. But there was no indication that, the Fed funds rate's going to be, raised by 550 basis points.
So you're saying, you say we're not doing bridge loans, and then does that mean that you have to do the extra work to get to try and secure a Fannie Mae loan or something like that? And so it just entails it entails extra work or greater or
it's just
additional requirements.
It's different. It's just different.
Okay.
It's a different execution. The bridge loan is more flexible in many ways. Different bridge lenders operate differently though. Some are easier to work with. You're paying more for a bridge loan, but it's floating rate, and the term is shorter. But you can often get some higher leverage with a bridge loan, which is the reason why this is problematic. Is people were leveraging up to 80-85%. Yeah. And even if your value has stayed the same, now we can only get leverage 65%, and at a higher interest rate. Yeah. And so that's where the big difference is. If you again $20 million deal, you were originally financing 16 million of it, so you bring 4 million in equity. Now all of a sudden your new loan, they're only going to give you a $10 million.
Did we have to do that? Did we have to say our LTV is changed now? New loan, new LTV.
The new loan is a lower LTV. Okay. And that shows how much we were able to increase net operating income and revenue.
Wow, that's great.
That's why, people don't, and investors and even some operators haven't truly appreciated what that change in average loan to value ratio does to returns, to tax benefits, depreciation, for example.
Yeah.
When you have depreciation from, you get accelerated depreciation, you buy an asset, you get all these, paper losses that you can use to offset income from the property. If you are, a real estate professional, you can use to offset other income, consult your CPA. But it's that depreciation, depending on how it's set up in the operating agreement. But let's say it's being split amongst the investors pro rata.
Yeah.
We have X amount of losses. Just because you split, let's say you were splitting profits and losses. Everyone's like, well, I just want to split profits. I don't want to split losses. But losses, when they're just on paper from depreciation, it can be a good thing.
Yeah.
So it's like, let's say it's 50-50. We're going to split the same amount of losses. There's 2 million. If there's 2 million in losses between you and me, that's great. We have to bring more equity. We got to bring on another person. We have to bring another 2 people.
Okay.
More people. There's the same amount of depreciation. Yeah. But more people, more equity to spread it amongst ourselves.
Yeah, yeah.
So there's less depreciation. Instead of getting
Oh yeah,
75%, and it's kind of 75% of one's 75 to 100% of one's investment back as in losses. Now it's coming back closer to 50 to 65%.
Okay.
So it's less appreciation to offset income. It's less returns because in a positively leveraged deal, leverage should increase your returns. Same concept. Less amount of equity, same amount of cash flow amongst a smaller equity group. That's higher return for them. There's more equity that has to get that return. Those returns are lowered. And that's a whole conversation of the perception of where returns should be today, and looking to achieve the same levels of returns of a couple of years ago using lower leverage is even more challenging.
That is why, it's a little bit of like mind blowing to me. It's like beyond my feeble mind. You can tweak some of these loan percentages, the smallest, most fine tuned, and that just and other numbers in your returns just blow it out of the water. Like one fine little tweak to some of these terms, whether it's LTV, whether it's the percentage of interest rate, a fraction of that change can really be multiple orders of magnitude higher when you're talking about
100%. Yeah, bringing more money on, changing your leverage completely changes the way a deal can look. That there's a lot of things. Another assumption that if you've underwritten your own deals, if you underwrite deals, the rate of inflation or rent growth, and if you've underwritten a deal and you look at a deal and you put in 0 rent growth in year one, but you're going to put in 3%, 4% inflation, the underwriting looks really bad. But that's what's happened in a lot of cases, is that they've had negative rent growth while they've had inflation. And maybe also the interest rate has risen, which also didn't.
It's a really good point. And, CPI came back, and, we knew that rent of primary residence is still sinking, but it's still quite high. And that just illustrates right there the difference between market rents are down and inflation is telling such a different story.
Yeah, it really is. Yeah. And we had obviously CPI print last week. We kind of covered it a little bit. Just
we
sort of knew what was, we kind of knew.
We called it.
I don't want to say it was like a nothing, but it was less consequential CPI print than others. I think September, which we've been talking about a lot. I think we're going to start seeing rents come in even more.
Yeah.
It'll be interesting. All right, Matt. Let's get to some of these. Let's get some of these reports. Although I think.
Thanks for the
absolutely. I think it was interesting
info on that.
And, we're glad to be off the bridge loan.
Learn a little bit about refinancing.
But funny enough, there's an argument to be made about we're doing a bridge loan right now on the right deal, not any deal. Could make sense.
Yeah.
If you think rates are going to be lower.
Yeah, exactly. And you're going to have a thirst for adventure.
Yeah. But the question is, it's like, I think rates are going to be lower, but not this year.
Yeah.
Next year.
Yeah.
Perhaps.
But how slow are they going to come down?
It could be a couple of years.
Yeah.
Could be a couple of years. Could be for a long time. Before I think we're going to go back down. So, all right. Berkshire Hathaway, Mr. Buffett himself, Warren Buffett's company, added new positions in D.R. Horton, NVR, and Lennar in the second quarter. Mr. Old Man Moneybags, Warren Buffett, really smart investor, making some big bets on real estate, Matt.
As I was writing my notes, I kept wanting to describe him as the plucky young Warren Buffett, the energetic, exuberant Warren Buffett has made, they call it a fresh bet, and home builders is what he's betting on. And I just, you scroll through here and you come in and you see they have a graph here of all the home builders that he invested in, and they are plotting it from the beginning of the year until now. And the lines are very much up and to the right. And some of these stocks have gone up 30-40%. Now, what's that period? Yeah, since the beginning of the year.
Well, they had really crashed the year prior.
Okay. But the story,
interest rates rising kind of cooled off. Everyone's like, I'm going to stop building.
And this is what's weird, I think. And what you see a real divergence in the multifamily decisions that are being made in terms of like, well, do I start a project now or not? Versus the home builder. Now, they used to be reasonable. They used to obey logic, but housing demand is it's almost illogically high. It is broken through kind of a threshold of reasonability, of reasonableness, such that
it's determined.
Yeah.
Determined. I mean, millennials desire to have whatever place that they think that they are entitled to or deserve, and baby boomers needing to downsize, move around. I mean, it's the story. I mean, there's a lot of stories out there. I'm just on the American consumer and just shockingly resilient and like, no, I'm going to keep spending money, and things keep cycling along, and we keep, we're waiting for the recession, but the consumer's like, no, we're going to keep spending money.
Yeah.
Keep buying a house. I don't care what the interest rate is.
And just yesterday we were talking, and we were talking about our more recent rent growth report. And, I was having trouble landing. I was like, how do I understand? And you made an important distinction between technicals and fundamentals. Mm-hmm. And as far as I understand it, is technicals is like looking at the pattern itself. Well, how does that, what kind of trends, what kind of math can you kind of apply to that progression of things? And then fundamentals is really the story behind it. Mm-hmm. And if you look at those numbers, and again, it's supply and demand. There's obviously, I'm missing a lot here, but if you look at that chart there on the Wall Street Journal article, it's like up and to the right. You get a little bit scared, like, well, is it going to peak? It certainly seems like it maybe it peaked. Yeah. There's got to be something to it. But if you look at the story, then it's like, oh, it's not really weird that it's going up, because it is driven by discrete factors and discrete events, and that's maybe the fundamental.
Well, and I think that's a good way to put it. And it's more than just the kind of the narrative around it, but it's true. What is the supply? What is the demand? How many people are going out and wanting the thing? Yeah. What is the price of the thing? And, using actual numbers in history and actuals to determine what, the future may hold when you're trying to do a forecast. Whereas like technical analysis, you are looking at like trends. Yeah. And the continuation of trends, or looking for, statistical inflection points that that probability says that something may change, or it's past a point, whether you're looking at volatility, or volume, and they can all be really good indicators. The fundamentals can be wrong. Yeah. Cannot be a good indicator of price often. And sometimes, the fundamentals can outweigh and overpower the technicals. Yeah. And that's kind of the case right now, where on the technicals, people are looking at, certain indicators, we're showing home prices should crash because, Jay Powell, and they say you don't fight the Fed. And you certainly don't want to be an individual fighting the Fed, but the housing market has really just... And
that's what my kind of conception of this difference is. There's a filtering that goes on if you're looking at just the line graph itself, or just like if you're, applying that kind of math to it. But if you're, if you're missing the story of housing demand, the story of, the reason why these home builders are actually seeing some success is because people... there's no other way to get a home.
Because people are buying homes. Now, you look at the numbers and you say people shouldn't be buying homes. Like, you shouldn't do this. But they are. They are. There's the demand because people are at an age where the biological clock is ticking, and they're like, I want you to have kids and have a place to live, and I'm just going to somehow figure it out. Yeah. It's wild. And Warren Buffett, is the classic value investor. And so this makes a lot of sense, and it tracks of like, no, look, we're seeing, I'm not going to look at the technicals of like, okay, just things seem priced from a, probability and statistic point of view, but I see the actual demand in real time because Berkshire Hathaway, they're already in the real estate business. They own real estate brokerages on the residential single family home side. They also own, lending mortgage businesses and commercial, multifamily and commeral.
Berkshire Hathaway, is that Berkadia, or did they spin off?
I think it's still wholly owned by Berkshire Hathaway.
Yeah, so there you go.
Yeah. They've always been a big investor in housing. And this is just, if anything, a double down.
It is interesting, the upshot of, or like the main point of this Wall Street Journal article was like, hey, Warren Buffett's investing in home builders. That's going to have some influence. A lot more people are going to be paying attention to this.
People do. People just follow his moves all of the time. And just a couple graphs.
Yeah.
Man, let's look at the charts.
So yeah, you talked about additional, kind of additional sources of information, additional trends, and this was one of the things that I jumped to as a way to understand. Okay, so where is home construction heading? And if you look, and we may need to resize the window here, but the numbers for home building for multifamily. Now, this is the amount of units currently under construction. For multifamily, it's this red line here. It seems like it's really soaring past, and at the same time that privately owned single family units are falling. So multifamily, a lot more under construction than single family. So you would think, oh well, that's a bad bet then. Don't buy single family home builders. Buy the apartment developers, or at least that's where the trends are. But
yeah, because that also signal that there's going to be more demand. Well, there's going to be better price increases from supply constraints in the future on the single family home builder side than the multifamily.
And that could be too. But like as a statement of builder interest or builder activity, that's where we are as a snapshot of builder activity currently. But if you want to think about maybe the future,
and then say these are under construction, not exactly permits.
So these are permits, and this is like the plans, maybe, or more of a little bit forward looking. And here you can see since about the beginning of 2023, permits for houses, single family homes, have increased, and permits for multifamily have gradually decreased. Now, there's a little bit more volatility for the multifamily, but still, the permits for single family homes easily are outdoing and following a completely opposite trajectory than the amount of units.
It makes sense. The the financing for large multifamily developments it's tight. It's hard to get financing. They're bigger deals. That's capital. It's more focused on getting a return versus the single family side, and they're looking at the single family side of being like, people are paying whatever for high interest rate. Either get high interest rate mortgages and they're still biting. Yeah, and you can kind of do it more, kind of a little bit more one-off, smaller deals rather than I'm going to finance the construction of a 250 unit multifamily. And they can be a little quicker to respond to the the single family guys.
Oh yeah, well, and that's what I was saying. It seems like there is a little bit more. Now everyone can be a little bit unreasonable. I'm sure that you've seen some in negotiations, but there seems to be some logic that the multifamily owner and investor has, that when you're buying a home, you really want that home. There's a little bit more of a heart into it, and also a higher demand for that property than there is for an apartment.
And that's that demand. And again, it's the difference between like the demand to purchase a single family home is more related to the demand to rent an apartment than the demand to buy a home is related to the demand to buy an apartment.
Exactly. Yes. Yeah.
So, and that would track with a little bit of a recovery kind of in the rental market. Still pretty, relatively soft, but a little bit of a recovery in just general demand for housing and nice housing.
I mean, we kind of saw this at the very start of the pandemic. We followed the fall off of housing and then the real, real streak.
When the single family home market started going crazy, when interest rates were low, what wasn't being reported on as much was, rents were going crazy. Occupancies were tightening up and rents were starting to move. And because our initial thought, which was, just an educated one at the time, Matt, was that the more attractiveness and price points of purchasing a home would lower demand for multifamily. Yeah. I mean, we were like, that makes sense, right? Like people who were going to rent are just going to go buy now. Yeah. But the reality was there was demand for all types of housing, and people were buying and people were renting. Yep. And so it seems counterintuitive, but I mean, even when we've had mortgage rates rise, the opposite. Yeah. We've seen the demand still be there, for both. When it's been good for apartments, way better to rent an apartment than is to take out a mortgage today. There's still demand for housing. Yep. Demand for housing is demand for housing. They move in lockstep.
Totally true. And I'd see kind of moving on to the John Burns article, really lines up almost the same. I think that this came out before the Berkshire Hathaway announcement, but it is virtually an endorsement of Warren Buffett's position here. There is such a high such a high demand for housing. It's pushing through any kind of mortgage hurdle that there may be. And people are owning homes for longer. They're in a house for maybe 10 years now. Now, I don't know where they got that factor, but it does make sense. They're holding on their homes because they don't want to. Yeah, because they don't want to sell and then have to buy a new one at higher rates.
Yeah, the golden handcuffs. I mean, why would you? Yeah, unless you really have the money saved up and it's not a big deal to your personal finances.
So that really just undergirds aside from housing demand. Yeah, that specific decision is like that's why there's home building. Yeah, is going so strongly now. But again, the huge upshot is the same one for this John Burns article as for the Wall Street Journal article, in that we need a lot more housing than we have. We're catching up to maybe a million units of housing that we need, and that means building.
yeah, we got to keep building. I mean, it's true. We're still not out of the hole that we've been in since the underbuilding of the last decade, and the fall offs and some of the permits that we saw from the last couple quarters. We're going to pay that toll in 25, 26 when we see a big decrease in deliveries, specifically in multifamily. And we still, as you saw, Matt, on the permits, I mean, are continuing to come down.
Yeah, and it should also be noted that these permits, not all of them end up as houses at the end, or
they're just good point. They're just permits. It doesn't necessarily mean they're actually going to get built.
But just to sum up the John Burns article, it really is it is that housing demand is so strong, and it was such an endorsement. It's such a really positive article if you're thinking about the strength of housing demand, which I think is a product of kind of economic well-being as well. And
if the home builders are like, 7% rates, we're good.
Yeah, then that means
that's a lot of confidence.
Yeah. And they're not going to spend that money just baselessly.
No. And Matt, in the article, did it get into how much of that is going into spec developments? I imagine the spec developments are still going down, but people are still demanding. Yeah. I've heard from more builders like maybe they're doing a couple spec homes, but that's really ramped down.
I bet so. Yeah, that would be a little dicier. But just this quote is really, just kind of sum things up. It says investors closely watch. How might inventory grow with a steadily improving economy, income growth outpacing inflation, relatively stable mortgage rates, and rising home equity? Those are the good reasons. There are some less good ones, like increased distress, particularly due to economic problems and consequent job losses. But we are seeing a little bit stronger signs from the economy, or at least some continued stability. Where there were predictions of recession around this time. If you were going back far enough.
Yeah, there's just so much chaos in the system, and that's what I think is challenging. Taking a step back and looking at the entire economy and not fitting into the same model and not following the same indicators that we've always used. Just don't seem to be working the same way. Yeah, and it's the pandemic and the shutting down of the economy and the stimulus that all ensued and followed, and just all of the the extreme measures that we went through, just added so much chaos to the system that it's going to take just a certain amount of time before we really normalize. And we've seen some of that normalization, but we've just had such an asymmetric hit to the system itself that it's not surprising that things are kind of out of whack and totally always
it's almost sense. Like people are, and I don't know, maybe there's this impulse with if we just have a recession, everything's going to be wiped clean and we can start building again. When no, there are parts of the economy that are going to do bad, parts that are going to be doing good, which is true in any case, but we're not going to get this reset.
I wish we would. Part of me wishes we would. Yeah. And if we had a true recession, whatever that means, we already had a technical recession. The whole economy doesn't always have to. The whole economy can be in a recession at the same time, but there's obviously sectors that have gone through periods of recession. Mm-hmm. And I mean, whether it's the tech sector last year, that's recovered in many ways, not fully. I mean, it feels like I feel like we're in a recession from a transaction standpoint. Yeah, I'm like, there's no deals to do. I mean, volume. I mean, you look at some of the big brokerage firms; their volumes are down 60, 70%. The profitability is down. 80%. I mean, they're not making nearly the amount of money. I mean, we're not doing deals for good reason. But we're all fine, but certainly making some different decisions on like how much money we're going to spend, and because we're not doing any deals right now. So it's different parts of the economy, I think have been behaving differently, and it's confusing in the consumer. But again, this is the consumer thinks we're in a recession. If you ask the average consumer, the economy is really bad. But at the same time, the average consumer is still spending a lot of money. And
if wages really are, kind of outpacing inflation, there are it feels weird.
It does feel weird. I do think that I think we're going to see some decent rent growth. This year we're going to miss all the projections of 3%. We're going to be under 3% because it's going to cool off. We'll probably have negative rent growth in December, maybe really slow in November. I'm thinking it's going to pick up next year, maybe. That's like my gut, and there's fundamentals and research backing that. But just like
if housing demand has follows the same really iron law that it's followed through the weird pandemic, even then, as home demand picks up, buying a home, they want to build a home. They're going to want to rent an apartment.
Well, and as wages continue to rise, if that happens, and if employment continues to rise and employment rises and unemployment stays so low, it's going to continue to drive household formation and occupancy and rent growth, and eventually, lead to more development and deliveries as well. But again, we say all this of like this should happen because of these things, but then there is who knows? At the same time, it's like expect to be unexpected.
Well, and that's why it seems like it would be so tempting to say, okay, let's just have this recession, get it over with. Rates could go back down. We can be in kind of a little bit of a sweet spot if we're insulated the right way.
Exactly. So
but I don't think it's gonna be that
sellers
easy.
need to realize where the values. Cap rates. Saw a great post I think CRE analyst did, and I reshared it on LinkedIn. Basically, it's like the 7 caps is the new 5 cap. Like just drill that in your head. Like if you're like, you should trade it to 5 cap. No, okay, 7 cap. That's where it needs to be relative to the triple B bonds. Just where the rest of the market is, like that's just like where we are now. That could change if all those yields kind of come in, but like it's getting into some sellers' head, not everybody. But like you need that recession to reset those prices to go down, the cap rates to go up, and then the interest rates can come down and the prices can come back up again. But all this talk of soft landing, no landing, while it's like oh good, we don't have to deal with the pain. Part of it is frustrating because it's like, no, we're just going to be kind of stuck in this, like, whatever this is.
You're going to have a little bit of a headache for a longer time instead of like a big headache all at once.
Now, it is good for real estate in the long term because, again, theoretically, we should see like pretty decent rent growth and inflation because of all of that. And, real estate does well in an inflationary environment. Our debt is being inflated away. So like, that's all like really good from that angle and from the long-term perspective. But it's going to be different from the last 5 or 6 years or even a decade of multifamily, last 5 years of multifamily investing, where you had a bunch of cap rate compression. And so, you could get okay growth, but the cap rates are going to compress. And so you could just pop it in a couple of years. Like that's never like been normal. Other than past couple of years. And it's going to be reverting back to the way real estate should be, because who's the arbiter of that?
It's the people that were expecting that got into the trouble.
Exactly. Yeah, they built the business plans around it. I mean, that's basically that's where people found themselves in very hot water. But you need to be prepared for any environment.
I mean, some rules still apply.
It's weird. And some rules apply now that should apply that didn't seem to apply previously. Like you can print money and you don't get inflation.
Or multifamily like supply. It's like supply is becoming more relevant, I think, this year than it was, the last 2 years. I think that's pretty obvious, but yeah.
Well, we'll keeping everybody updated, Matt, every single week. It's a dynamic environment, but make sure that you're subscribed to the Great Capital YouTube channel.
Can we talk a little bit about supply just for a second here?
Oh yeah, I'm not dumb. I'm just
all right.
I'm just telling people they got to subscribe.
I thought you were closing up. I was like,
not yet.
I was trying to segue into another article about
more
apartment supply.
But we got to tell people to subscribe.
All right.
Comment.
No. I know. I just if I had a good if I waste a good segue, I feel
I know, but my segue, Matt, was to your rent report that just came out. That just came out. Matt published. We published an awesome new report last week. It's on rent growth and multifamily performance in 2023 and beyond.
Yeah.
Find it at greatcapitalllc.com. It breaks down a lot of big markets. Yeah, we're doing a webinar. Probably it'll have already happened by the time this episode gets posted.
Yeah.
So check out the replay. Again, if you're not subscribed to the Great Capital YouTube channel, you're not going to know about these webinars. Maybe you're going to miss it. So make sure you're subscribed. Watch this. Go back. Watch the replay. We're going to be getting to a little bit of the stress of loan maturities, but a lot more on just like rent growth, performance, supply, absorption, rent to income ratios, what that means for multifamily investors. It's going to be really informative.
Get some extra stuff. I'm talking to a mathematician friend that's going to help me, kind of crunch the numbers a little bit. Some extra content that's not in the report.
We're doing some, we're just having fun with the numbers. But we're trying to apply some. We talked about technical analysis earlier. And applying more technical analysis that's typically applied to public markets for good reason, because a lot of pricing data. But we have access to a really good amount of real estate data ourselves, and trying to apply some of those same techniques so we can, infer any information, any signals that we can look at.
And I wanted to note that too in our earlier discussion. Yes, they each have their advantage. Every investor is going to always look at both, like just inherently, I think.
I mean, technicals and
fundamentals.
You would think. I mean, some people.
You would think.
You would think, but no. Some people. I mean, some people are pure one camp or the other. Yeah, you would think that you'd want to be aware of both. No, a lot of traders. I mean, I have done this for entertainment. I've traded futures and options. Literally all right, I'm going to trade this amount of money and be okay if I lose it. But you're purely going off of technicals, like purely. I mean, I used to, in the pandemic, like I would trade after hours, S&P futures, after dinner, I would try to see if I can make a couple $100, like in how long it took me to make
that's funny.
I was like, literally, I'd try to see if I could pay for dinner. Not smart, or it's high risk, high reward. But that was all off of. There's nothing new happening typically. I mean, if there was, but it was all off of just price signals and signals of it being overbought or oversold, and momentum and volatility, and because today, not necessarily the private markets, but especially the public markets, and especially something that's traded as high frequency as like the S&P 500 or like SPY. There's a lot of volume. There's a lot of there's so much inputs there that you can hold on.
So the robots don't the high frequency trading they can't outbid you when you're trying to do something like that?
Sorry, I lost my train of thought, but that's exactly what is going on. There are so many other people that are trading off of technicals that it's a little self-fulfilling prophecy. So like we were talking about
interesting.
So we were talking about relative strength index.
Like
everybody's looking at the same technicals for the most part. When everybody sees the RSI or the relative strength index, cross above 70, everyone knows that it's overbought, or below 30. Everyone knows that it's oversold. And there are just simple trading algorithms that all they operate on, might be, this would be a very simple one, but every time this stock is above this RSI, sell it, and if it's below, buy it. And that's all I want you to do. And so, you have a lot of bots that are just doing that, but then you have individuals, and then there's psychology of like, round numbers and certain, the resistant points. And levels of support of like, well, the price at this point yesterday or this point in trading, you never got below this price point. So you're like, I'm going to watch this price point. If it falls below that price point, that means that it could go all the way down to this next. And a lot of that is based on like, Fibonacci retracement levels of like, all right, the next downward range is all the way to this price point. And we break through that point, if we see resistance there, which none of that has anything to do with like
jumbo.
You can call it astrology, soft science, but it also
works
statistically. It works.
I made a lot of money off it.
When you learn about like Fibonacci, retracements and Fibonacci sequences, it kind of sounds like here's this crystal. It's going to provide you energy.
Exactly.
But at the same time, you apply some of those Fibonacci retracements to just a lot of different any chart, any equity, and it's like there's actually like something to this. There are certain like laws, and it's all we're looking at human psychology.
Well, and that's
pricing,
and it's a little bit up there. If I could say, if you account for some kind of fundamental or some kind of real world thing that explains it, maybe they can complement each other.
Yeah.
But
and if you think, and if like
look at a pretty line, I think.
And not to get too like philosophical, but it's like if everything in like nature is made up of like the same stuff and like just closed systems and open systems, we're all the same stuff, and we're interacting, all kind of abiding by the laws of physics. When we're looking at like closed like economic systems or like markets, they're going to have some reflections to like the natural order of the physical world also, and just people we're also agents in this like larger system that are making a lot of different choices, seemingly with consciousness, but often seemingly at random. So, and we can observe these patterns over time in many different circumstances and whatever you're looking at.
Yeah.
And there are, patterns that emerge that are, statistically significant. And like, it's not always, that's why it's like statistics. It's like something can be 99% right, but then there's a 1% chance it's going to be wrong.
Yeah.
But if something is correct a certain amount of the time, you can. Maybe,
it's hard to argue.
Maybe that's why the casinos make money.
It's true. Yeah.
So,
or a little bit back to the real world.
China.
I'd like to stay in the U.S. for just one article
before we go to the East.
There was a Real Page article that looked at.
Oh, I tried to go to the Real Page article, I think, and we wanted to finish talking about John Burns.
Yeah. I took you off with a bad segue. Now this, and I want to just not fly through this, but I'm going to neatly summarize here. It is the big point here is that for almost all the markets in the United States, a peak apartment construction has already happened. We're well off of it for many of them. The apartment market has definitely cooled. And there's like a lot of variation to not only like rent growth patterns, but apartment construction patterns. And RealPage really lays this out effectively in the article. Now, I think at first glance, so they have listed here in a chart the total quarters lapsed since the multifamily construction peak, and the top markets, which are at their peak right now for construction, are Detroit, Indianapolis, Miami, New York, Newark, and San Diego. This is in terms of number of units, by the way. And then some of these markets where there are 7 quarters removed in the past, way in the past, their peak are places like Chicago, Boston, LA, San Francisco.
These markets aren't building as much anymore.
Yeah, exactly. They're the ones that aren't building as much. And so at first glance, it seems kind of like the markets that are currently enjoying higher rent growth are the ones where peak construction activity is happening. I think Chicago is a big outlier under that logic since it has seen robust rent growth recently, but it is very far past its peak for apartment construction. It has the third biggest gap.
It's I'm trying to find like the big like relations, but it's not like all the Midwest is in one category.
Yeah.
And it's the second quarter of 23, 1 quarter removed. Detroit, Indy, Miami, New York, Newark, San Diego. I'm trying to connect all those dots.
Yeah. So I it does seem a little bit like the Midwest is getting the construction trend a little bit later than the Sun Belt.
That's true.
But with an important caveat is that for these Midwestern markets of Detroit and Indianapolis, which are the 6 markets that are at their peak right now, for these markets, Detroit as a percentage of units, as a percentage of current supply, Detroit's under construction units is 3%, and that's their peak right now.
Yeah.
Phoenix, which is way past its peak, 9.3 currently under construction as a percentage of supply. Phoenix, their peak was way, way higher and way stronger than ours. Is like Phoenix would love to have, for an investor in Phoenix would love to have that. Indianapolis is at 4.6% of construction as a percentage of supply. Cincinnati, which is far past its peak construction, has 3.8%. So not a huge difference. for among the Midwestern ones, which are around the 3s and 4%. But man, it doesn't say much if you're past your peak when you're still at 9.3% of.
You're still building a lot.
Yeah. So that being said, it's hard to argue against the fact, though, that just as greater supply affects demand, and that higher performing markets, I think higher performing markets are going to incentivize the apartment developer players in the region to start a project there. Yeah, this is what look at how well these.
Well, and there's a little bit of a lag too. Because it's like, okay, you see Indianapolis just crush it this year. And we're getting now developers start paying attention. Investors start paying attention. And, they're back to technical analysis, the trend can be your friend, and, there's a positive trend in that direction. Maybe you'll see continued growth, but you also can be too late to the game.
I think that the lateness of the crest is reflected in its, whatever we had, maybe we missed the boat when it was trendy to have a lot of construction, and it's really there. I think it's a fraction of the fundamental stability of Midwestern markets just aren't as swingy.
Yeah, well, it's true
as some of the other ones.
No, I think that's a good point, and I think that there's probably a little bit of demand for something. There's probably some thirst quenching component of a less volatile market of just give me some steady eddies, good returns. I don't have to worry about it. It's got to be an appeal there, especially to some buyers who have been dealing maybe in the Phoenix market, Austin market, Texas, Florida, those just highly competitive markets, which have been great, probably will be over the next decade, but it's hard to get into and make sense of. Well, Matt, thanks for stopping. Thanks for making sure we hit that piece
problem.
Because great piece from Real Pages, Carl Whitaker, friend of the show. Okay, New York Times, why this company's financial crisis threatens China's economy. We're talking about China. We're talking about real estate, Matt. Should I care? Does it matter? Do you know? Sounds like New York Times doesn't really know.
New York Times doesn't know. I don't know.
Come on, you're the doctor here. Give us the prescription.
Well, okay. So here's my prescription. Watch this space. It's hard to think that. Okay, Evergrande. 2 years ago,
remind us.
Evergrande collapsed. Oh, I thought
couldn't pay their bills.
I thought that this was some kind of linchpin or like a domino, because there's so many investments that are held up in the Chinese real estate market. As opposed to a lot of other things in a way that is unlike a lot of other countries.
That's how they. One of the primary methods to store wealth is in buying real estate. Real assets. They like gold too.
That's what I was going to say. It's like you can hold it on your mattress. You can build that building. You see it. It's right there. It's not going away.
You can use it.
Well, for some of them, and some of them they're not doing so well.
You can't own it. It's like a 100-year lease. Or whatever.
Oh, is that what it is?
Yeah. You can't actually own like property in China. But you can have like a 100-year lease with the Communist Party. Or
the Evergrande was one of the companies that were building these buildings. And they had a well publicized collapse that a lot of people, me included, thought that this could be the beginning of a kind of a contagion that could affect the global economy. But when Evergrande's collapse turned out to be not quite as earth-shattering as predicted, that kind of quieted my alarmist impulses, or at least has affected the way that I'm reading what is happening right now.
Matt, who takes care of all these plans on these buildings?
See,
I'm sorry. This is the headquarters of Country Garden's office in Foshan, China. Experts, my brain is making me read this. The experts fear the company's building is going to be overgrown and more foliage.
No, that's the company's troubles could spill over to the financial markets.
Same thing. So they're overgrown. No, it's like really, sorry, I digress, but I'm just thinking about who's like trimming all this. Anyway, so what is the difference? What is the effect? I mean, these big developers took out a lot of debt, obviously, to build these residential buildings, condos. They don't do multifamily in really most of the world like we do here in the United States. It's mostly like condos, individual owners, maybe turn into a rental.
Wow.
But it sounds like they just are unable to pay their debt, and they have quite a few loans coming due. What is it? $200 billion in unpaid bills.
I mean, the fact that Evergrande didn't make the splash that people were expecting makes me think that they could figure out a way to either save country gardens or
through like some kind of bailout,
or insulate the economy from its from its effects.
Because China, the last I heard, China isn't as stimulating as much as people thought that they would have, and they can flip, they can turn it on and off, as they desire to, if they want to make this go away, or there obviously may be downstream effects, but I think that the question is more on how will the CCP react rather than just how in a free market system will this one company, because we could maybe forecast what might happen to this company, but it's more of like what's China going to do.
And this is kind of the relevance that I see, at least like that I'm assigning to this issue. I put this in the category of like, how prepared are we? How are we as globalized as we were before? How vulnerable are we? And did Evergrande send a warning signal to people? Don't be exposed to this Chinese real estate. And have we learned any lessons from Evergrande?
Is there any de-risking? Yeah, that's a really good question. Is China do anything different? Was this kind of forecasted? And did they put any firewalls in place? The big question, the question that the New York Times and most people are asking is, okay, whatever the effect is in China, how can this affect the global financial markets?
Exactly.
Because China is obviously major engine in the global economy. If they go down, it's not going to necessarily be good for everyone else, especially
and that's what I say. It's like that this broader category of how is the global economy doing versus the U.S. because the U.S. has taken a sometimes very different trajectory when it comes to inflation and interest rates and GDP than other countries. And even though, like, I think a lot of times maybe the world economy kind of follows the U.S. economy, we are divergent at the moment. And is the global economy going to catch up to us, or is it going to take a little bit of our shine off? So I don't know. And I don't think the New York Times knows here, except just it's hard for me to count out the resilience of an economy as big as China's. Bigger than 200 million for sure. Billion, I'm sorry.
Well, according to the New York Times, can the government save Country Garden? Their response is maybe. They have pulled all the stops before. And it sounds like, there was a lot of change that took place after the Evergrande kind of fiasco. In Country Garden, apparently, kind of was a poster child of like doing the right things. So I think, again, it's a question of, what could there be to come after this? Is this the first, is this just the next one of many? Is this is it a one-off situation? And again, what are the spillover effects if it spills over into China's economy? How does that affect, the rest of Asia? Trade, and then the global economy itself, which, a slowdown in China might be a good thing for inflation. Could be.
Regardless of all this, and that's, there is a source of some uncertainty and maybe some doom. I don't think that anyone's really seeing a huge, scary shadow, whether it's in the Southeast Asia economies or in Europe or elsewhere.
And then we got to be aware of it. There's nothing we can do, obviously, about it. So we just have to be prepared, aware. But, I think stick to, our guns and just going slowly but smoothly, but making some good decisions. And again, focus on the things that we can control. Again, we've talked about, China, global economy, U.S. market, U.S. multifamily. We talk about this every week, but at the end of the day, it comes down to when we're investing in real estate is submarket, the neighborhood, the street.
Don't look at China. Look a little
project, what you're trying to do, what value can you add, what's needed in that specific little tiny spot that you're affecting and changing the place and the demand and the economy right there. Obviously, there's macro and larger factors that can affect all of that, interest rates, inflation. But what are we going to do to control what's happening in China? Focus on things that we can control. And we're going to find some really good opportunities out there.
be ready to shift when the market does, too. Because, man, there's so many times when people thought maybe the good times would keep rolling, or that shift wouldn't continue. And, there could be a shift of improvement when it comes to interest rates or even housing demand that could come. And just, being careful doesn't mean not reacting to things.
Yeah, exactly. Yeah, exactly. Being careful doesn't mean inaction.
Yeah.
And I've been concerned that people view Gray Capital right now as oh, you guys aren't buying deals right now. And it's well, we haven't bought a deal. It's not because we haven't tried to buy a deal. I still think right now is a great time to buy multifamily real estate, but it just has to be at prices that I think make sense. And so maybe that means we're not a buyer, but we are. Just it has to make sense. It has to make sense. We have to come back in line with things that are reasonable. And I don't want to, rush in just because of the fundamentals, but the prices are mismatched.
Yeah.
The prices have to be right. And I'm not, again, coming back to the perception of risk that investors and LPs have. We're not. It's not a time. It's never a time to to roll the dice and accept much lower returns, hoping that something will happen.
Yeah.
Whether that's interest rates falling, or rent growth just skyrocketing. Both of those things very well may take place. But how much credit are you willing to give to those, and are you willing to accept a much lower return if that doesn't occur? So
setting yourself up to succeed when things still could turn more negatively than you expected is I think is as crucial now as it was when you got forced rich.
No, there's a lot of the deals that you don't do, you avoid doing, which are the wins. There's a long list of deals that I'm glad we didn't do that. I'm glad we said no. I'm glad we stopped pushing, because at the time it's a great deal. You want to do the business plan, you want to do all but it's you got to draw a line in the sand and remove the emotions from it. I mean, emotionally, we want to do a deal. Everyone in the office, all of our investors, we've got more interest in wanting to invest with Gray Capital, Matt, than we ever have. We all want a deal. But it's we're not just going to just pick a deal because everyone wants to do a deal and the details don't matter. That's not how we're going to do well.
If I nag Addison enough, maybe he'll find one for me.
Nag away. Nag away.
He said, what did he say? Well, you just said you can just go in there and bid more. Yeah, get us a deal, Addison.
Whatever works within reason.
Yeah.
Thanks for watching this episode of The Gray Report. Make sure you subscribe to the Gray Capital YouTube channel. Hop on over to graycapitalllc.com, or you can go to graycap.net.
Sweet.
A little shorthand. If I don't want to type in the LLCs, get graycap.net. Graycap.net.
I love it.
Really quick. But anyway, we got newsletter signups, so you're getting hit with a lot more than these articles. It's the best multifamily newsletter in the market. Sign up for that. Check out the report. We got the 2 reports up.
Watch the webinar that's probably out there.
Watch the webinar watch the webinar replay right after this. It's probably going to give you suggestions. Just watch it right now. And then stay tuned for my interview with Grant Cardone coming out soon.
Awesome.
All right. See you next time.